Okay, we're continuing along. This little matrix here, which is probably in the textbook as well, gives you an overview of the differences between the choices, the three main choices that parent companies have on how to record the investment account while they're waiting for the consolidation to occur. The equity method, we pretty much know about what that does. This summarizes the equity method. The initial value, and by the way, the equity method, even prior to consolidation, will be based on the percentage ownership. Right now, we're going to probably keep our problem simple to where it's 100% ownership. But as we know, consolidation can be for less than 100% ownership as long as there's control. So it could be technically somewhere between 50 and 100, and sometimes other percentages. Back to the other methods used for the internal keeping of the investment account, the initial value remains at cost, dividends declared as dividend income, and then the partial equity is described here as where the investment account is only adjusted for income and dividends. We don't do the other adjustments that we learned about the other in the equity method, and those adjustments, just so I know you know what they are, but you could say them. It's the depreciation, it's the amortization, it's the recognition of moving from book value to fair value based on what was paid at the time. So partial equity is just the accrual of the income and recording the dividends as a reduction of the investment account. Those are the main differences in those two from the equity method. Or rather, that's the main difference in the partial equity method. Okay, so why does this all matter? Well, you're going to need to know when you go to do the consolidation what's in the investment account that you're eliminating. This is theory, and it's going to be like, okay, I hear what you're saying, but I don't understand what you mean. So we'll have to see it when we get to actual examples. But one thing's for sure, when the textbook gives you the A and the S and whatever other letters they give you as acronyms for the elimination entries to go from two sets of general ledgers to one consolidated statement, whatever else there is, I'll just say XXX. When they do that, one of the things that happens in those variety of entries is that the net result of the investment account does go to zero. That's for sure. It has to. But these entries, these letter entries, are going to get the investment account based on what's in there. So you have to know what went into the box. If the equity method went into the box, you're going to have to take the equity method out. If only the partial equity method went into the box, then the adjustments will only have to take that much out, et cetera, et cetera. So that's why you're going to need to know that. However, there's a shortcut method, we'll get to it, if you wind up in something other than the equity method, which we're going to concentrate on. So we're going to really learn how to go from, whoa, listen to that truck. I'm doing this in the middle of the highway. I know it's a little risky, but it makes for some interesting lecture material. Cars are looking at me like I'm crazy. Okay. If the investment accounts on the equity method, that's what we're going to concentrate on how to do that. And the reason for that is it's really simple once you learn the trick to go from these other methods of the investment account to the consolidation. So once we learn how to go from this to the consolidation, these become very easy, and that's why we do it this way. All right, a lot of theory here, and professors saying a lot of things, and people are saying, ho-hum, who cares? Let's just get to the problems. Well, the slides don't let us do that right away, but let's see where we're at. We're going to now learn how to prepare these consolidated statements subsequent to the acquisition date. So we really should have a drum roll here and a symphony orchestra ready to crash bang into a crescendo, because we're really now going to start seeing it. The approach will be, like I said, we're going to concentrate on it as if it was equity method, and we'll do a little bit of these as well. So let's see what happened. During the year, the parent will adjust the investment account. In the first order of business, we're going to learn it from the equity method. So the parent is doing the equity method, and what it does is these things. That's what we learned about. It's no different than the equity method used in substantial influence for Chapter 1. All right, here we go. We get to see real numbers, real examples, and as I promised you, great, fantastic names for parent companies. Look at that. Parrot Company. Wow. Now that's clever. Followed by Sun Company. And of course, the giveaway is there. If you haven't figured it out, the giveaway of who's the parent and who's the subsidiary is there. Really, the giveaway in all problems should be just look at what it says. Parent Company obtains all the outstanding company stock of Sun Company. What's not said here is, and it's pretty much a given from here on out, that this is a case where Sun Company continues to exist as a legal entity. Otherwise, there's nothing to talk about. There's no consolidation that we have to learn about, because as we learned, if Sun Company goes away and its assets and liabilities are merged into Parent Company, there's only one general ledger. You know how to prepare financial statements with one general ledger. This is where we're going to have two general ledgers, and that's what has to be put together. All right, this kind of information here is also familiar to you. This is Sun Company's balances at the date of acquisition, 1/1/14. These are the fair values. Here's the differences in the net asset values between the book values, the net asset fair value between the book values, and it gives us a lot of neat information. Let's see what we did. The stock, this was acquired for cash. The stock was acquired for cash, $800,000. And the net book value of Sun Company was $600. The fair value of its net identifiable assets are $800. So it looks to me like we've got, and I think it should look to you like we've got somewhat. Looks to me like we've got, I'm going to guess, but it looks like we've got $80,000 of goodwill here. That's what it looks. Let's see what, there we go from here. Well, how do you like that? It's as if I knew what was coming. Again, this is what we've done before. That's why this is a course that builds upon itself, that is cumulative, and why you needed to get the first two chapters drilled down you like I did, ad nauseum. I know I upset a lot of you because you got sick and tired of hearing me say the same things over and over again, but here's why. We need to know all of this to go forward for the consolidation subsequent to the acquisition date. All of this will continue to be part of our work papers each and every time we do a consolidation. I don't care if it's year 2015, 2016, or 2177. Gee, I wonder what the world will be like in 2177. Maybe we'll have a class discussion on that too, on the same day when we talk about the differences between the parent company keeping the investment account on the equity method, partial equity, or historical cost. So we could have real interesting discussions that day. All right. You may be wondering what I've been drinking here as I give this slide show at home. And I'm going to leave the choices of what I've been drinking to you. We can take a poll on that in class when we get together next time. Okay, so we've got goodwill of $80,000. We've got differences explained between the book value and the purchase price and the fair value of the net identifiable assets, which are trademarks, patented equipment. If you have any doubts, just rewind and go back to this and make sure you can get to this. You must be able to get to this on your own as quickly as I did on slide 10 at this point in the course. And I'll say it now, if you're having any trouble, don't be bashful. Come to my office, make an appointment, and let's get you squared away so you can get to this stage without much trouble. All right, let's go forward. So now we know that we are going to have amortization depreciation. And what you should basically start getting into your homework assignments and your Excel spreadsheets, start an Excel spreadsheet if you haven't started one. Start an Excel spreadsheet where you create the ability to record amortization And the textbook uses the word amortization as a catch-all phrase. It includes depreciation. I will always, not always, but I'll probably constantly mention depreciation rather than the way the textbook just calls it all one as amortization. And that's because clearly the equipment is being depreciated. Trademarks and patented technology are arguably amortized in the way we use that word. And of course, goodwill is indefinite, will only be checked for impairment. Notice what they do here. This is really cool. They note that the net of these two is $7,000. Well, and that'll be for 5 years until the equipment is done, because that's the shorter of the two that are being amortized, quote, / depreciated, unquote. So basically what they're telling you by showing this net is that you can almost bank on the fact that each year there's going to be a net adjustment to the income that we would be doing under the equity method to the investment account held by the parent during the course of the year prior to amortization. The reason why this is important somewhat, and it's really not important to get the net, but the reason why keeping a schedule like this is important is because you will be able to answer problems that go from, say, this acquisition was in 2014. You're going to answer problems easily enough that show consolidation at the end of 2015 after 1 year. But some problems are going to say, well, let's go to 2 years later, or even 3 years later, or more. And so you're going to want to know, like, okay, well, what does that mean in terms of these numbers? These numbers are going to be amortized or depreciated down from where they start, and we're going to need to know each and every year that goes forward for the work papers where we stand. Again, it's easy to talk about. Seeing it will be much more enlightening when we go. So let's move forward and see how this example works. Now, this was an acquisition, to go back to the original point. This was an acquisition that took place on January 1. That is indicated here. And now we're going to start getting into what happened during the course of the year subsequent, and there's the key, subsequent activity. All right, what I'm going to do is I'm going to stop here, and we'll pick up on the next recording from this point. So when you get back to the next YouTube, maybe bring your notes forward from this last video so you can continue to follow this example. So we're going to I know this is like a cliffhanger. Okay, like, well, what's happening? But we'll pick it up you can watch it right away if you want. But I'm going to start after I recover from the beverages that I've been drinking. Okay. All right.